In this presentation, we will take a look at the calculation of return on investment, ROI, this being related to an investment center. Remember that we have three different types of performance centers that we need to review and evaluate. One was the cost centers. These are centers that don't have any revenue but need to regulate their costs, so we need to evaluate them based on the regulation of their costs. These are going to be costs that are typically going to be used and necessary for the day-to-day operations of the business. Then we're going to have a profit center. This is where we do have profit in this center. There is revenue, and of course there are costs and expenses, and we can measure the performance based on the revenue less the expenses, one of the major factors, one of the major types of measurements that we would use for a profit center. Then we have an investment center, and these ones are a little bit more tricky because the investment center you can think of may not be looking at just the short term or the immediate operations of the business, but may be making investments for longer term type investments, and therefore we're going to have to use some different tools to measure the investment type centers. Now note, the investment type centers probably aren't the first center we would think of for the heart or the day-to-day type of operations of the business. The cost centers and the profit centers are really what's going to happen from a day-to-day perspective. The investment centers, oftentimes we're thinking about, again, those longer term type investments. And because we have a longer horizon out, we have to use different measuring tools. In other words, we can't just measure the investment center based on the net profit for a particular period possibly, because they may be foregoing short-term profits in order to achieve more long-term profits. And that would be a good objective, a good goal if viewed from the correct perspective. So we need to have different tools for a longer range of decision making. One calculation that can be used for this is rate on investment, or ROI. So we'll go through the calculation of ROI, rate on investment. So ROI is going to be equivalent to the profit margin percent times the investment turnover. So profit margin percent times the investment turnover. This is one of those calculations that has two components to it that is not always the easiest thing to find. In other words, we need to know what the profit margin percent is and the investment turnover. We need to know what those are. We're not just going to be able to pull those from the financial statement. So then we got to break out, if we're looking at the ROI, what the next question we're going to ask, of course, is, well, what's the profit margin percent? How do we calculate that? And you'll recall from basically financial accounting, we should be able to see the profit margin percent is, we're talking about an investment center here. So we're thinking the investment center net income. And notice a lot of times in managerial accounting, they may not say net income versus income. When they say sales, a lot of times they're talking about the top line revenue. If they say income, sometimes they mean net income or the bottom line. So just recall and remember that, just be aware of that. There's going to be a distinction that you might not see in some financial accounting, in some managerial accounting kind of lingo, versus income versus net income. Income basically means net income or net in some way, possibly a lot of times. And sales, of course, means revenue, the top line of it, or income. So then we have that divided by the investment center sales. So again, we're talking about an investment center. So we're talking about the net income divided by the sales. And that's going to be the same for financial accounting. So when we consider financial accounting, we've got the net income over the sales. That's the profit margin percent. The next thing, of course, we're going to need is to know what the investment turnover is. The second component of the ROI, the investment turnover, is going to be equal to the investment center sales. Again, we're talking about an investment center, so it's going to be the sales or the revenue, the top line item. And then we're going to divide that by the average assets. So average assets. So now we're going to say, average assets. What does that mean? Can I just get that from the financial statement somewhere? Where's average assets? When you see average assets, a balance sheet account, a lot of times when you see an average of a balance sheet account, what's going to happen is we're going to say, all right, take the beginning assets, take the ending assets, and then divide it by 2. And you might still say, well, how do I know what the beginning? Do I have to go to the GL to find the beginning assets, the general ledger? No, you don't, because you can go to the last year's financial statements and say, what happened last year? What were the assets at the end of last year? Ending assets last year, beginning assets this year, and then we have the ending assets this year. We're going to add we'll add those two together. What the assets were at the beginning, what they were at the end of the year, we'll divide by 2. That'll give us a kind of average. Why would we do that? Because we're trying to get what we think the assets would be at any given point throughout the time period, an average of any kind of given point throughout the time period. We know that it's a balance sheet account and we only see assets as of a specific time period. We're trying to get as if it was some relevant number that would be an average at any given point within that time period. So that's going to be the concept of the average. So once we have that information, we can say, okay, the profit margin percent, we're going to try to calculate that with our data up top. What we have is the sales, we've got the net income, we've got the beginning assets and ending assets. We're going to calculate the ROI. We've got the profit margin percent here. That's the first thing that we're going to need to calculate in order to figure this out. Here's our overarching formula. In other words, profit margin percent times the investment turnover. We first need to figure out the profit margin percent. So profit margin percent is going to be the net income. And again, some textbooks might just call it income. We're pulling that from our data. And then we're going to take that and the sales. And we're going to divide it by the sales. So if we divide that out, we're going to get a percentage. So 33.49, it's an estimate. And of course, all we did was take the 7500 over the 22392. That's going to be about 33.49%. So that's going to be our profit margin percent. We found this number for A and B. Then we want to take a look at the investment turnover. The investment turnover is going to be the sales. So it's going to be our top line item, revenue. And then we've got the average assets. Again, usually we say, I have the average assets. Well, what is that going to be? Well, sometimes a problem will give it to us if we're in practice, or they might give you two balance sheets or something like that. They give you two balance sheets. It's going to be the end of the last year's assets. Ending balance will be this year's beginning balance, and then the ending balance. So we're going to say, the average beginning assets or last year's ending assets, which are this year's beginning assets. And then we're going to take the ending assets, add those up, divide it by 2. That's going to be our average, right? We got two numbers, we add them up and we divide by 2, and that's going to give us the average assets, in this case, the 28,644 and the 21,504. Now we have the average assets. We can go back to our investment turnover part of the ROI calculation and say, all right, we've got the sales. We know the average assets now are going to be the 28,644 and the 21,504. Therefore, we can get the investment turnover, which is going to be the 0.78. And of course, we just took the 22,392 divided by the 28,644, and that's going to be about 0.78. All right, so now we have the two components, and we can finally get back to the return on investment, ROI, which is going to be the profit margin percent, the 33 about, and the 16, and the investment turnover, and we can multiply those together. So 0.33 times the 0.78, and again, there's rounding involved, is going to be about 26.18. And again, the reason it's different here is because there's going to be rounding involved in this particular problem. So between A and B, we're seeing that the 2618 is higher, so that would be a more favorable ROI as compared to the 11.36. Also note, if we were going to be a little bit more specific on these calculations, remember these are rounded, it's closer to 0.33494 and times 0.78172 for just so you can see the difference between the rounding, and that's going to be around 2618.